Insurance Law, Unit 3. The important concept here is life insurance. So what is the definition of life insurance? In Section 2, Clause 11 of the Insurance Act 1938, life insurance is defined as any contract where one party agrees to pay a sum upon happening of particular event contingent on duration of human life. So it is a contract where the insurer promises to pay the insured upon happening of something to human life. So the subject matter in life insurance is human life. In the case law Talby versus London and Indian Life Insurance Co., the insurance law life insurance was defined as a contract to pay money on death of a person on consideration of due payment of certain annuity for his life calculated to probable duration of his life. So the premium is paid according to the life of the insured. So if his age is less, then the premium will be less. If his age is more, then the premium will also more. Kinds of life insurance. The first is whole life insurance. In whole life insurance, the insured pays his premium for his entire lifetime. The period of insurance is for the insured's entire lifetime, and the policy matures only after the death of the insured. When the insured dies, the policy automatically matures and the claim will be given to the beneficiaries or the relatives of the insured. The next is term insurance policy. So unlike whole life insurance policy, in term insurance policy, the premium is paid only for specified years. There is a period that is set for the insurance policy. It can be for 10 years, 20 years, 30 years. The insured doesn't pay premium for his entire lifetime year. He pays only for a specified years. And he will get the claim only if he dies within this specified period of insurance policy. For example, if the insurance policy he has taken the term insurance policy for 10 years, and if he dies only within this 10 years, he will get the claim. If he dies after the completion of 10 years, then he will not get any claim. So this is term insurance policy. The benefit in term insurance policy is the premium cost is very low compared to whole life insurance policy. The next is endowment insurance policy. In endowment insurance policy, it is also a policy where term is set. The period for insurance is set. So the premium is paid during endowment years only, and the policy matures after the endowment years are completed, and he will get the claim only if he survives the endowment period. Say for example, if an insured takes insurance for 5 years, and if he pays premium for his entire 5 years, and if he survives these 5 years, then after 5 years, if he is alive, then the policy will mature and he will get the claim. But if he dies within endowment period, then he will not get any claim from insurance. Benefits. It's more of like an insurance plus savings. So it's like you are saving money and you will get more money after 5 years. And also if he dies within the endowment period, he will not get maturity, but the agreement may specify that he will get the premium return, etc. The next is unit linked life insurance plan. The premium here is 5 years locked policy. So this insurance policy is specified for 5 years only. It is a 5 years locked policy. So it is more of an investment type of a policy. So you will have to pay premium for entire 5 years, and the claim will be payable only after 5 years. So it doesn't depend upon your death. If you die before death, then there may be premium returns. But if after 5 years, the policy will automatically get matured, and they will get the claim in unit linked life insurance policy. Benefits. In ULIP, you may withdraw partial claim if necessary, if required, before 5 years. The next is money back insurance policy. In money back insurance policy, it is a periodical payment of lump sum benefits until maturity. So in the other insurance policy, the claim is given only after the maturity of the insurance. But in money back insurance, you will keep getting certain claim even before maturity. Like for example, for every 4 years, you will get a certain claim of insurance until maturity of the insurance. The next is Grift life insurance. So in this kind of life insurance is given by employer to his employees. So for a group, this life insurance is usually done by an employer. The next is child insurance plans. The child insurance plan is done to meet the financial needs of the child. For the educational needs of the child, this policy is done. So the insured pays the premium for his child, and when the child reaches his age of majority, say for example 18, then the policy will mature and the child will get the benefit. The next is retirement plans. So this is done by the insured for his retirement. So he pays premium until his retirement, and after retirement he will get the maturity as a pension. And if he dies before that, then he will receive maturity as death benefit. The next question is persons entitled to payment of life insurance. So who are the persons entitled to payment of the life insurance? The first is payees or insured. So the insured himself is eligible for getting the payment if he is alive during the maturity of the insurance. The next is nominee. If the insured is not alive during the maturity, then he may hire a nominee to receive the claim. So in whole life insurance, it is usually the insured hires a nominee, and the nominee after the death of the insured will receive the claim. He is nominated by insured. The next is assignee. So instead of hiring a nominee, the insured hires an assignee. So assignee is nothing but, for example, if the insured has taken a loan from a bank, so when the policy matures, he will say to the insurance, he will assign the bank as an assignee, and he will ask the insurance company to pay his maturity to fill the loan in the bank. The next are legal heirs. So if there are no valid nominee and assignees, then the maturity claim will go to his legal heirs through succession. Then the next is executors and administrators. So if the insured has done a will and there are no valid nominee and assignee, then the insurer will hire an executor to execute his will. So the insurance after maturity, the claim will go in hands of executor and he will distribute it according to the will. Administrator. If the insured has not hired any executor to distribute his will, the court will hire an administrator to distribute the will, and the insurance claim will go in hands of that administrator. The next is appointee. So in case of child insurance, if the child is below 18 years and the insured dies, the maturity will go in the hand of the appointee, who will keep the money until the child matures, reaches the age of majority. The next important concept is Life Insurance Corporation Act 1956. So Life Insurance Corporation LIC composition. So section 3 says that it consists of board of directors. So the board of directors consists of 18 members. At least among those, at least one is woman. And those 18 members consist of a chairperson, chief executive officer and managing director, and then there is an independent director. Powers and functions. So section 6 of this act speaks about the powers and functions of a life insurance corporation. So their powers are to carry life insurance business in India or outside India. Then carry reinsurance business. So spend funds. They can spend funds of a LIC. Acquire, hold and dispose of property. They can hold property or even dispose the LIC property. Transfer property. They can transfer LIC properties. Lend money. They have the power to lend money on behalf of the LIC. Then carry other business vested on LIC for profit. So to get profit for LIC, they can carry on any other business. Then borrow money. They can even borrow money for LIC in the name of LIC. The next is General Insurance Corporation of India. Powers and functions. So section 18 of this Act 1972 says that the powers and functions of general insurance corporations are carrying on general insurance corporation business. So they have to carry on the general insurance corporation business within India or outside India. The next is aiding, assisting and advising the insurance companies in setting standards of conduct. So they advise or help or assist the other insurance companies to maintain in the setting of a standard of conduct to run their insurance companies and sound practice in general insurance business and rendering efficient service to policyholders. So they advise their insurance companies. The next is advising companies in a matter of controlling their expense. So they help the companies in controlling their expenses. The next is advising companies in investment of their funds. So how to invest the insurance company's fund, they will advise those companies on those subject matter. The next is issuing directions to companies in conduct of general insurance business. So they issue directions to the companies on how to conduct their businesses, their general insurance business. The next concept is the short note. Ask for a short note: medical or health insurance. So what is the medical insurance? Definition: it is the coverage for the loss of a hospital and medical expenses arising from illness or injury. So it is the coverage for loss of a hospital and medical expenses arising from illness or injury. So it is the insurance where the premium is paid to cover for their hospital and medical expenses. So what is the claim? How the claim we get in this? So for the room charges, if you have taken a room, if you got admitted, and for the room charges you get 25% of the claim, total claim. Then for surgeon, after admitting to the room, if the surgeon operates on you, then the remaining 25% of the claim the insured will get. So total 50% for room plus surgeon. And for other medical expenses, the insured will get the remaining 50%. The other medical expenses may be the medicine fees or blood testing, anesthesia, etc. For that 50% of the claim the insured will get. Age limit to take medical insurance is from 5 years to 80 years. So this is third unit of insurance law. The next major concept is motor vehicle insurance, which I will cover in next video. Thanks for watching.